So before Brandon and I begin to discuss how to manage a portfolio, or really how to determine the difference between an efficient security and an inefficient one, let's understand exactly how markets work and what drives the markets. And really the markets are driven only by one thing.
Supply and demand.
The law of supply and demand. And that's true of anything that's liquid. And supply and demand then is driven by investors and their predictions of the future, and then how confident or emotionally they believe that their future predictions are going to be true. That's why markets will go through periods of being very stable and efficient, and then investors sometimes get confused, and you'll see that reflected in increase in volatility, and you ultimately see either bubbles or busts. So that's why the heart of our program is built around volatility and the analysis of volatility, which is a leading indicator of future price action.
So Tom and I want to draw some observations from our Canterbury Volatility Index, which is highlighted by this black line. This blue line is the S&P 500 index. Now Tom, do you see a relationship between the blue line and the black line?
Well, there seems to be an obvious relationship, and that is they're kind of negative of each other. They're moving opposite.
They're negatively correlated. They're inverses of one another. And so the first thing, the volatility index is similar to temperature. This green zone down here is below 75. You want to keep volatility below 75, and if you do that, you can see that this line right here, where this CVI is below 75, is trading rationally. It's trading in an efficient market. But on the other hand, volatility is also a leading indicator.
Well, as we're coming into 2007 and 8, we can see that the volatility was very stable, and we had this really nice move with very low drawdowns. And then we can see before this big drop occurs, we can see an increase in volatility, and we can also begin to see that this volatility gets out of the green zone, which means it's getting higher. And again, after that, we see a market crash. Now, that doesn't always happen. We will sometimes see an increase in volatility, and it kind of goes back to a bull market. But one thing we know is every decline is preceded by an increase in volatility, and we want to try to avoid that in terms of either our portfolio or the individual securities that we own at a given point in time.